Welcome back to Money Exchange. They've meddled with their currency and manipulated their local stock market and adjusted their local interest rate lower half a dozen times throughout 2015. Of course, I'm talking about China, the second largest economy in the world and the largest commodity consumer. Joining us from Singapore is Annette Beecher, Head of Asia Pacific Research at TD Securities. Hi Annette, and welcome to the program.
Hi, Andrew. Merry Christmas.
And to you too. Tell us, Annette, China is such an important player in this part of the world. Are we likely to see it try and manipulate its currency lower next year as the US dollar continues to rise and next year, of course, with more rate increases from the Fed and China pegging that currency? Are we likely going to have to see it manipulated a little bit lower, do you think?
Oh, I'm loath to echo the term manipulated. I guess we don't really talk in that sort of language now. Now that China is a reserve currency, I think in some ways the PBOC is letting the market set the rate, and perhaps it's been the market now that has set CNY lower and lower, and hence the CNY fix has been following that. I must admit I did think we'd be sitting at 635, 640, so I'm probably a little surprised to sort of see the big changes in recent weeks. And secondly, the big gap between onshore and offshore is also something that the PBOC said they didn't particularly welcome, and yet we haven't really seen a lot of sort of adjustment to try to get those two exchange rates sort of back in alignment. So I guess we're all a little bit fumbling about what does it all mean. Are they trying to depreciate? You obviously don't want to depreciate too much because that encourages capital outflows. But I do suspect that it's easier to frame it around, well, the Fed is tightening, the US dollar is tightening, and by definition, you know, all boats should be floating lower. So maybe heading into next year, we could be talking about, you know, maybe 660, 670, maybe that's our new range. But to be honest, the move recently has been quite rapid, and we haven't seen any official discussion about, you know, what this means for the currency going forward. That, to be honest, I guess we're a little bit in the dark. The bottom line is, though, the Chinese economy, it's not struggling by any stretch of the imagination. It's probably growing at probably 6.5%, 7%. Exports have been struggling, but that's not China's fault. It's because Europe in particular has been a drag on import demand, which is a key trading partner for China. So I think coming into next year, I guess I'd like to see all EM currencies ease a little, and we'll give the countries a little bit of a cushion heading into what could still be quite a tough year.
I must admit, on the program, Annette, I don't think I've had anyone accurately predict the end-of-year price target for the Aussie dollar quite as well as you have. I think last time we had you on the program about a month ago, you said 71 cents, and I think we're thereabouts, and it's at about the end of the year, so we'll draw a line in it and say well done. So next year, though, with the Aussie dollar, is it the US that is going to push the Aussie lower, or is that vulnerability still in the commodity markets? I mean, the Aussie dollar seems higher than really where it should be based on where commodities are right now. Which one is likely going to weigh on the Aussie more? Is the US Fed tightening, or commodity markets still remaining weak, or maybe a combination of both?
Well, we can actually throw in one more, Andrew, and say, well, what's the global demand for the Aussie dollar? Because we did a little bit of work this week. We had the financial accounts, which is usually a bit of a yawn. But what it tells you is who holds Australian bonds. And who holds Australian bonds in its heyday, sort of 3 and 4 years ago, it was 75% held offshore, and that's now down to 64%. So the rest of the world seems to think, you know, I like Aussie bonds, I'll hold them, but I probably won't hold as much as what I would like. But when you compare that share of offshore holdings of Aussie bonds, that probably accounts for a couple of cents for the Aussie dollar. The rest of that you do have to sort of overlay commodity prices, and it's a particularly ugly chart. If you take the iron ore price and put iron ore over the top, Aussie dollar should be closer to sort of 68, maybe 69 cents. So we have this tussle even excluding what's happening with the US Federal Reserve, we have a tussle between the rest of the world is still not returning all that much, and Aussie's still a AAA rated and decent returns. So for next year, I do expect the currency to ease, and this time next year, let's have a conversation. I think it'll be 67 cents. But let's see how we get there. But at this exact point in time, it's not about the Fed, because that Fed 25 basis points is so priced in, it was so well telegraphed that it really wasn't new news. What might be new news is our house view is looking for another 100 basis points of tightening, but the market's only got 2 more hikes. So that'll be the tussle for next year. So by definition, if we're right and the current and interest rates are 100 basis points higher in the US, we could see a little bit of downward pressure on the Aussie.
So I take from that statement, and at 67 cents this time next year, is that our crystal ball sort of area, or are we? I mean, I know 12 months is a long time in currency markets, it's a long time in financial markets, but obviously 67 cents is somewhere you think the Aussie might drift to at some point next year.
Yeah, I think the range might be a little bit, we could actually get a little higher where we are now. I think the RBA has done a terrific job. I know they're always criticised, but I think the chances of a rate cut are fairly low. What's probably not discussed enough is the RBA governor does have his retirement party in September, so that does create a bit of a dislocation of the handing over of the job. So I think that does make it tough to cut interest rates in that environment. And in fact, a survey I read a couple of hours ago tells us that 2 people out of 23 expect higher interest rates by year end. And if that's the case, you can forget 67 cents, it'll still have a 7 handle on it.
Wow, high interest rate. Okay, so if we're watching markets next year, and of course in currency markets it's all about the expectation of what central banks are going to do with rates, what has to happen here in Australia for us currency traders to start to see an expectation of a rate cut? I mean, commodity markets obviously are probably not going to drop as much as they did this year next year, or the anticipation is they perhaps won't, but what would have to happen here in Australia for the RBA to turn around and drop rates 0.25% next year?
Well, as I'm sure you discuss a lot on this program, and you can't be a Sydney-sider without having this discussion, is house prices in the housing market. Because it's pretty clear that that's the sector that's holding up the economy at this point in time. And through house price inflation and housing construction, we're seeing the consumer hold up quite well. You put those two together and you've got 60% of GDP. But if we believe the headlines and see that the investor market is leaving, auction clearances are starting to fail, therefore house prices are starting to fail, if we really see a downturn in housing and by definition consumer spending on the back of that, we're going to see the RBA come back pretty quickly on the back of that. Added with, I don't see a rebound in commodity prices anytime soon, but obviously they might be necessary, but it's not sufficient for a cut. But if we see housing and the consumer stumble in 2016, we are certainly going to see the RBA governor back talking about rate cuts.
And there was a little bit of a whisper this afternoon about the Bank of Japan injecting some stimulus. What can you tell us about that? Because I haven't been at my trading desk. I know they perhaps haven't injected a significant amount because the yen has actually strengthened a little bit. But what can you tell us about that that's happened this afternoon?
I certainly can, because I wrote the London briefing just before this report, and I actually had it all written in anticipation of hitting send, and suddenly I had to add an extra paragraph saying that the BOJ managed to wake us up on a sleepy Friday afternoon. So what happened was they left their purchase program at 80 trillion, but the 2 things they added separately was they're going to buy another 600 billion of ETFs, and they're going to extend the duration of JGBs. So before it was mid-curve, sort of 3 to 5 years, now it's more 7 to 12 years. And so it's a bit like an Operation Twist, whereby they're going to keep the curve flatter for longer. And I think it's more about, at the time, it was a shock. It's like, oh, Bank of Japan's done something. So the yen moved and the Nikkei spiked. And then we got through the nuts and bolts of it and thought, oh, a bit like the ECB. It's like, oh, is that it? And everything just came back. So it was a very, very brief interlude in what was a very quiet day otherwise.
Interesting times for next year coming up. And thanks so much for your support on the program this year. Have a wonderful Christmas, and we look forward to having you on Money Exchange again next year.
Thank you. Look forward to it.
After the break, we'll see what emerging market currencies are going to be hit hard in 2016, and what can we expect from the euro? Is it going to move back to parity against the US dollar? Now the Fed has started to lift rates. We'll be back in a moment.